Markets have gone straight up ever since the ceasefire gap, but heads up, Thursday's close leaves a massive opportunity for pullback. Not only is there a monthly trend line that ties in beautifully with call wall resistance in the SPX at 6,300, but more importantly for this week, value area from Thursday is way too top heavy, and Friday's futures are already putting longs off sides. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 6 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off today on the SPY monthly time frame chart so we can take a closer look at the resistance trendline that everybody's concerned about. It's roughly 630 in the SPY, which is 6,300 in the SPX. And I would be far more concerned with the call wall and the nuance from the options market at 6,300 than this resistance trendline, and let me show you why. If we zoom out and take a look at historical examples of just using previous highs to possibly make trendline resistance, notice that the market blows right through this area of resistance and actually uses it as support before continuing the rally in the upward direction. It's a pretty low hit rate there. If we take a look at connecting this previous high to this high, so we're using anchor and then touch number 1 right here, the same thing takes place. The market breaks through, actually uses that trend line as support, and extends the gain in the upward direction. The example that everybody seems to be over-indexing on right now is if you take a look at this as the anchor, doing something along these lines here, so anchor, touch 1. We come up shy on the first test. This is the pre-sickness drop high, and then you do get a little bit of a pullback off of it here after making a new all-time high, but that's only one of the instances of these trend lines. So again, I would not over-index on the fact that the resistance trend line is going to cause the resistance. I would be much more concerned about the short-term nuance of price action. Let's take a look at the weekly time scale here and continue along with our classic analysis. What do we see in terms of candle structure and location? In terms of structure, solid green-bodied bar, very minimal upper and lower wicks, strong close near the highs of the weekly range, buyers are in control. In terms of location, on the bar-to-bar count, a massive higher low as well as a higher high, and a close completely outside of and above the previous week's range, along with the previous all-time high. We're clearly sitting at the highest high in the weekly trend count, which means even if we were to develop a weekly pullback, the weekly chart can afford to set a weekly higher low. The picture perfect higher low would look something along these lines over the previous all-time high at 613, but I would give the market the benefit of the doubt, and I would also say that as long as we're over the top wicks of these two red-bodied bars back here, which is roughly 604.75, that would be a great spot for a weekly higher low as well. Now, if we do want to reference the China gap down here, I would call out that with the Fibonacci's now, you're getting perfect confluence out of the Fib 38.2 from the new all-time high. Notice the 38.2 is right on the money with the top end of that weekly bar here, around roughly 571 in the SPY. It wouldn't be ideal, and there's definitely daily downtrends to trade during this time frame. However, if you're consolidating over a Fib 38.2, I can't really change my tone to being aggressively bearish here. Let's go ahead and take a fib from the low of the price action post gap up. And what we'll call out is that the Fib 38.2 in this view is also right near the highs of the two red-bodied bars that we were just referencing, close to about 604.75, reinforcing that level. If we take a look through the lens of the anchored VWAPs, we're above the entirety of the stack. There's really not much to read into from this perspective or from the volume profile perspective, but we'll check in just to be congruent and thorough in the analysis. If we do something along these lines, it's actually great confluence, the top edge of the high volume node here with the top end of those two red-bodied bars. I'll say it one more time, 604.75. Let's take a look at the daily time scale and see what we get from a weekly expected move perspective. If you're not familiar with the weekly expected move, it is this gray box right here, and you can check out the video tutorial in the top right-hand corner on how to set that up. If we're contained by the upper bound, the number's at 634.85, implying a higher high and a brand new all-time high. If we're contained by the lower bound, 615.85, we are also implying a massive higher low in the daily trend count, so the expected move has to strike me as being bullish. Obviously, just like the weekly timescale, we are trading at the highest high of the trend count. We have highs, higher highs, this is the highest high. We have lows, soft higher lows, firm higher lows. The market could pull back. I know not many people will like this, but the market could pull back and still offer a daily higher low over 604.75, which was the reference point we were just talking about on the weekly timescale as being the top end of the two upper wicks from the red-bodied bars that we had here and here. So if the daily chart looks like this, it's still technically a higher low. Now, there's better places that a higher low could develop ahead of that level, so let's talk about those first. The first one would be over the top end of the two-day balance range here from the Monday and Tuesday session. If I just zoom in a little bit closer to the price action, you can really see how we had that Tuesday inside bar broke out on Wednesday and got follow through via the gap up on Thursday. If the gap closes, but we can stay over the top end of the two-day balance range, this could easily constitute a daily higher low if the hourly trend flips to down. It seems likely to me because we would be taking out a previous candle's low. We would be closing a gap as well. And we'll see in just a moment as well that on Friday, we are slated to open somewhere around here based on the futures. We'll see where we open up Sunday night. But for the most part, 618.50. Let's just get back to business here on the SPY. 618.50 possibility for a daily higher low there. I would be less inclined to try to trade shorts into that level and rather just gauge the market reaction for something that looks like this. I would prefer to participate on the buy side of the market, looking for the higher low and the next leg in the upward direction. If we take out 618.50, I would not be short through the two-day balance range here. I would be looking for the next possible higher low, which is over 613, the previous all-time high for something that looks like this on the daily timescale. The only time where I would really start to short this market more aggressively, and by aggressively I'm saying coming into the day with a bearish bias, looking to hold shorts for more than just quick base hits, I'm talking about really having a bearish bias on the market, it would really only come in if we take out the previous all-time high at 613, Brigade bolt underneath, and try to offer that deeper pullback towards 604.75. If we can find some shorts between A and B, that's really, in my view, where it makes more sense to have that more bearish bias. Anything above 613 is really seeking a daily higher low here on the S&P. Let's take a look at the hourly chart and get a little bit more nuanced here as we move closer to our magical chart of the value area with the market profile. I think this reinforces everything we've talked about so far. Here's the two-day balance range. You can see it. We broke out on the Wednesday afternoon session. There has been no pullback to Brigade bolt over the 618.50 to confirm it as support. So the first thought, and I'll just go over to the futures right now actually, notice how we fell apart through the overnight session after the Thursday shortened session. Looks very likely that, at least as of right now, we'll open somewhere near the lows of the Thursday session. So let's just go back to the SPY hourly chart here. If we're opening around this area, notice there's still plenty of room for that 618.50 level to possibly act as support for the daily higher low we were just mentioning. We close the gap, we look for buyers to step up there, and then we navigate back up to the all-time high. The key level up here is at 625.75. If we Brigade bolt through it, we should be targeting the upper edge of the weekly expected move. As I mentioned on the daily chart, I'm really not interested in being short inside of this balance range here. I would much prefer to wait for some sort of breakdown underneath 613, right? Something along these lines. Let's just say that we pull back more aggressively. We're in here. Maybe there's a short or whatever. The market tries to rally and then fails. I would prefer to be short here. Why? Look at the thin structure. This thin structure retracement is far more attractive to me than trying to trade inside of this range and inside of this range here. If the market does get some kind of rally, let's say we open here, we rally, or we open up here and then Brigade bolt to the upside, I would certainly keep an eye on the 630 mark in the S&P, but intraday price action has to determine whether or not sellers start to step up here. If they do, again, I'm not thinking about this massive groundbreaking short, oh my God, the market's going to pull back and fall apart completely. It's more like, okay, do we come in? Do we close the gap? Can we find buyers here? Can we retarget? Do we push through it? Do we get to the upper edge of the weekly expected move? Maybe there's a backing off from that level. I really wouldn't frame the market this upcoming week as being, oh my goodness, let's look for a black swan event off of 630 just because it has that monthly resistance trend line based on everything we've talked about so far in today's episode. Even if you did want to take a more isolated approach, what is this market showing us? If we just go back to the daily chart here for just a second, I don't know about you, but I count at least 3, if not 4 gaps that are really in play here. This is the China gap up. This is the EU tariff pause gap up. This is the ceasefire gap up. This is the labor report gap up on Thursday morning. This is a runaway market. This is a lockout rally in the upward direction. Who's making all the money in this market? It's definitely not the shorts, right? So I would want to maintain the bullish stance based on that evidence. If we just go back to the hourly time scale, we can throw on the anchored VWAPs from the intraday perspective. This just reinforces that I really wouldn't want to be an aggressive short unless we were underneath 613 because of the anchored VWAPs coming from this prior to the ceasefire gap and then after the ceasefire gap. If we're underneath 613, then yeah, maybe there's a little bit of a deeper pullback through the thin structure. But ahead of that, it doesn't really make sense to maintain any sort of large bear stance. If we come in here with the Fibonacci's from the bottom of the most recent leg higher to the top end, your Fib 38.2 is just a hair off the upper edge of the 2-day balance range from in here. Once again, reinforcing that if we were to get some kind of pullback towards that 618.50, first thought is, can we get a daily higher low to preserve the trend in the upward direction? If we drop down below it, notice that the Fib 61.8 is right here at your 613, reinforcing both of the key levels that we've already described in today's episode. Let's clear that up. Let's take a look at the market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. Let's just ask a very simple question. Are there any red flags here that indicate buyers are not strong or stronger sellers are stepping up at the exchange level? The answer is no. Strong volume inflows every single day of the week. You can see the advanced decline line closes over 0, 0, over 0, over 0. The cumulative build out of the tick is positive every single day of the week. Stronger sellers are not stepping up for some sneaky major mega market crash in the background at the exchange level. Let's take a look at the market profile. If you're not familiar with this software, this type of chart, check out the video tutorial in the top right-hand corner. What we were talking about in the introduction, the possibility of a pullback, stems from the fact that buyers really have poor trade location on that Thursday session. So if you're a short-term trader, a quick draw McGraw trader, you can absolutely look to fade this market on rallies that reject underneath the value area low from the Thursday session. And on the ES futures, I believe it's 18. Yeah, 63.17, 63.18. If we're rejecting that area, it's very possible that longs who are trapped from up here are trying to get out for as close as possible to break even. Now, do buyers closing out cause market crashes? Not really. You need aggressive selling, like, oh my God, let's unload everything across all of the sectors. There's no place to hide. Sell it all. That's what's required. Not longs who possibly have a little bit poor trade location looking to just reestablish at a better price. So I would look for some backing off from that level, and maybe again it causes a little bit of a pullback before we get to that 6,300 in the SPX, the 630 in the SPY, but it's nothing detrimental. And even at that, recall that we have the top end of the 2-day balance range, which is really back down here around 62.65, 62.60 on the ES futures. That's possibly going to act as support. So if we do get an open here, rally, reject the value area low, which is roughly, again, 63.17, 63.18. Let's just say, I don't know, some kind of head and shoulders there. Market pulls back. I would then be looking for support around 62.65. If you want the SPY equivalent levels of the value area low, just look at the bottom end of this red-bodied bar right here. You would probably need to see a breakdown underneath, or a rejection, I should say. If we're slated to open here, a rejection of 624.50 that rolls over, possibly closes the gap. You could look for this as like a very nuanced intraday scalp from point A to point B. That's fine. I'm not saying there's anything wrong with that trade, but when and if you start to approach 618.50, it's a much better spot for a higher low on the higher time frames. And that to me is going to be the far more lucrative trade opportunity in the market as we walk forward. So that is your S&P analysis. Let's do it all for the QQQ, and let's see what's going on with our friend the NASDAQ. Let's go to a monthly chart just to check in on that resistance trend line. Let's see if it's even a thing here on the NASDAQ. Let's go out to a 20-year chart and let's see what we've got. Let's just draw it in with the crayon, not the firm thinkorswim tool. You do have the same idea for the trend line. I would be, mildly cautious of that. I wouldn't overly index on that. If we take a look at the smaller time frames, let's quickly zoom in here and see what's going on from a weekly structural perspective. Very bullish looking bar with that longer lower wick, indicating that sellers actually tried to step up and keep price inside of the previous week's range. Buyers said, no way, Jose, and we're going to close it right at the tippity top of the weekly range, outside of the previous week's range, and clearly outside of the previous all-time high. So just like the S&P, very similar. Buyers are in control structurally and location-wise. If we do see a pullback, the ideal pullback is some kind of higher low that looks like this. You could split hairs and say that this is really more of a zone, as long as we're over the top end of those two upper wicks as well. It's the same concept, weekly higher low there. If we check in on the Fibonacci, it's not quite aligned with the bottom end of the China gap here anymore. It's sort of in no man's land in between the China gap. So nonetheless, if the market were to pull back more substantially, test that. Maybe it's here at the weekly 50, the blue moving average on the screen as well. I'd still be bullish from this higher time frame perspective. It doesn't really change the narrative of, oh my goodness, the market's going to fall into this massive downtrend and it's going to be the end of the world. If the market starts to accept underneath the China gaps on all charts, right? You could reference any chart that has the China tariff pause, deal to make a deal gap. If the market accepts underneath these levels down here, I'd be far more concerned, and we'll start ringing the alarm bell. But I mean, my goodness, let's take this chart at face value, one step at a time. Strong close, highest high of the trend count, really no major issues for now. Obviously, we'll be over the entirety of the anchored VWAP stack, and there's really not much to learn as well from the volume profile, just like we had on the S&P side of the house. You can see here, high volume node is right at the upper bounds of those two red bars. Let's take a look at the daily chart for the QQQ, firstly evaluating the weekly expected move as we typically do, just like the S&P 500. What do we have? We certainly have a rinse and repeat. You've got yourself the opportunity for a higher high up here at 566.56 and a higher low at 545.88. So if we do get that, I mean, the daily uptrend remains intact, just like the S&P 500. You have lows, you have soft higher lows, firm higher lows, clear opportunity for a higher low at the expected move, clear higher low opportunity at the previous all-time high. And I would go so far as saying you have a clear opportunity for a daily higher low over the top end of the ceasefire gap, which ultimately is the top end. It's the equivalent of that 604.75 we were just looking at on the S&P 500 anyways. So if you get a pullback here in the short term, I wouldn't be shorting any of this. I wouldn't be shorting this. I wouldn't be short here. I would only maybe take a stab short at the QQQ if we started to drop down underneath the lower edge of the weekly expected move, which ties in with roughly 546.25 as a key area of support from these previous lows there. We could see that on the hourly chart very, very clearly, right? The big concern headed into the end of the week, really it was the Wednesday session, right, was that this had the opportunity to perhaps develop as a head and shoulders. Clearly that did not take place. There's your high and tight consolidation from Wednesday. Here it is from Thursday. As long as this neckline is not being broken at 546.25, I would not be aggressive on the downside at all in the QQQ NASDAQ side of the market. If we were to breach it, then just like the S&P, you start to get into a little bit of this thin structure. This is thin structure as well, and there's that key daily line in the sand anyways, up against the top of the ceasefire gap, 536.25 that we were just talking about. I'd give a little bit of credence here to the 541 area. It is possible you get a little bit of structure off of that. However, the NASDAQ side of the market does not really have as clean of a structure point compared to the S&P 500. So main line in the sand has to be 546.25. As long as we're above it, I would not take any sort of bearish stance on the market. If we do get some sort of gap close here, first thought would be, is it possible for a higher low off of 551? That's probably even an hourly higher low at that point, right? You have highs, and then if this is the last hourly equal low, let's call this an hourly balance range, lows equal lows, highs equal highs equal highs. This is a break to a higher high. If the higher low wants to stay over 551, buyers are in control anyways. Let's take a look at the anchored VWAPs intraday and see what we can learn. I think this reinforces everything we just talked about relative to the head and shoulders here and the neckline being at 546.25. And if we come in with the fibs from the bottom here up to the most recent high, not really getting great confluence out of the fibs here, maybe a little bit of reinforcement at this 549.50 area. You can see the high and tight consolidation from the Wednesday session. If you were to drop that, I would expect a little bit more of that pullback to ensue towards the neckline of the pattern. But once again, do I want to be a big short inside of this area where the market's clearly been a little bit more range bound, a little bit more responsive trade instead of trending trade in there? Probably not. Probably not. Still, the idea remains trying to buy higher lows on the higher time frames. Let's take a look at the NASDAQ side of the market internals. Anything to glean from this? Ask yourself the same question we did in the S&P 500. Any issues with this? I think the answer is a glaring no, especially with Tuesday, right? Tuesday, the NASDAQ side of the market had relative weakness. We saw that breakdown in the NASDAQ. Let me zoom in here. Look at what happened internally. And I know we talked about this on Tuesday's midweek market update, but you didn't have any indications of stronger sellers stepping up at the exchange level. It was like a liquidation breaks, buyers stopping out of positions perhaps, but you didn't have like follow through at the exchange level. Let's sell it all. And oh my goodness, tech is, it's going to go on this massive breakdown. Not even close. Look at the strength out of the advanced decline line, most notably on that Tuesday session. So I'm just not seeing it. I'm not seeing the argument for a large breakdown. And, for that reason, we continue to trade the probabilities, and probabilities, in my view, favor more upside. So higher low pullback's the name of the game. Same concept here out of the NASDAQ market profile. You can see your high and tight value area here. We're already slated to be underneath on that Friday session. So if we rally and reject, the level here on the NQ futures is about 23,040. If you rally and reject that, that probably puts the pressure on to close the gap to the downside. If you get above it, it's just, rock and roll. Let's continue to rinse and repeat. Brigade bolts over the all-time high, continue to unlock blue sky territory. What else can we say about the market profile? Really not much. I mean, the 2-day balance high is in here around that 22,850 mark. If we just go back on over to the QQQ cash, I do want to arm you ultimately with the level for the pullback. Not that I'm sure you couldn't find it yourself, but 550. If you're underneath 550, that is where you have trapped overhead supply. So say the market is slated to open here, just like the S&P on Monday. If you get a rejection, just like we outlined in the market profile, you could look for this overhead supply to sell into that. The more lucrative trade is probably this as a quick scalp underneath the gap at 553.25 to 551. When we get here, as we've already mentioned, what are we thinking about? We're thinking about higher low opportunities to really navigate in the direction of the overall trend, which remains in the upward direction. Let's reset this. Let's take a look at our good friend, the Rusty Russell, and finish off the broad market on this note. There's going to be no monthly resistance trend line to talk about here, so let's just go back to the weekly and take a look at that. Let's throw on the clean drawing set. What do we see? The Russell's starting to participate in a more meaningful way. There's been a much more meaningful break in the upward direction. Solid green-bodied bar, decent little lower wick. They're supporting over the weekly 50 SMA, over the previous highs from back over here. That does strike me as constructive. The next major target is up here closer to 230 on the Rusty Russell, which is another continuation bar in the upward direction should we achieve that in the coming weeks worth of trade. If the market pulls back a little bit more aggressively, the main thing you would want to avoid is a breakdown of loosely the weekly 50 SMA, which is close to about 215, 216 right now on the charts. As long as you get a higher low over this sort of consolidation chop and slop, that would be a great spot for the buyers to step up and preserve the trend in the upward direction. If we come in here with the Fibonacci's, remember that some of these retracements of what we've been tracking recently, well above the Fib 68.1, remember the odds increase for a 100% retracement there. And did we get a more firm push on this time scale? The answer is yes. This is the more notable one, remembering that this is the all-time high in small caps and this is the low from the tariff turmoil volatility. If we can start closing more weekly candles over the Fib 68.1 on the retracement, the odds dramatically increase once again for the 100% retracement, which would be bullish in terms of market breadth for the S&P 500, the NASDAQ, everything in general. You have much more bullish sentiment if the breadth of the market is confirming the rally that we're seeing in those heavier weighted indexes like the S&P and the NASDAQ. Let's take that off. Let's come in here with a fib from the low to the high now. Fib 38.2 sort of suggesting as long as we're over 203.50s is looking pretty good. And I would actually say that that's a pretty solid look here, remembering that on the higher time frames, just grabbing more time, literally, doing something like this, as long as we're outside of this box, the market's trying to remain constructive here for a small cap rally in the upward direction. Let's drop this down. No, let's not drop it down just yet. Let's go ahead and take a look at the anchored VWAPs on the IWM. Why not? This is going to be different, of course, right? You have much more of this cluster underneath us. I think it reinforces the idea that higher lows can be found on this higher time frame that would keep the market constructive here from a breadth expansion perspective. Let's take a look at the high volume node in terms of this on the weekly. And what we care about is this high volume node. We're ever so slightly right at it. So that'll be a top watch. We don't need so many years here. We don't need 20 years. Let's go down to a 5-year chart. I think we'll do it. Let's go to a 5-year weekly. There we go. There we have it. So just a hair over the point of control, actually, from this perspective, it'd be really solid to start extending above that, then having the opportunity to use that as support. So all up, base case from the higher time frame IWM weekly charts, this is going to be constructive for your S&P 500 rally in particular, which, of course, just wants to keep us on the bull side of the market. Once again, reinforcing, hey, let's not look for that big 630 market crash, monthly trend line. Oh my God, it's the end of the world. It just doesn't make sense based on the underpinnings of the market right now. Let's take a look at the daily time scale for our good friend, the Rusty, and we'll keep moving along here. So the weekly expected move is always up first. What do we see from this perspective? Here it is. Upper edge is at 228.55. That, of course, is a higher high. And the lower edge is at 217.64, higher low. So higher highs and higher lows sound like an uptrend to me. That would be bullish on this chart. This, again, is the same pullback we were just talking about, as long as we can stay over the weekly 50 SMA, which is confluence with the daily 200 SMA, which is this previous pivot high, then buyers are in control. I like what I'm seeing here on the extension, especially on the labor market gap up. The reason that is very important is because the strength in the labor report on the Thursday session would actually indicate that Jerome Powell does not need to be as aggressive with cutting rates, right? The report came in way stronger than everybody was expecting, which probably decreases the odds of a rate cut. And we know that small caps really like rate cuts. So the fact that this rallied on the premise that rate cuts are not coming as quickly still strikes me as bullish here out of smalls. If anything, we just take the labor report at face value, which is that people aren't losing jobs. We should not root for people to lose jobs, even if it means the Fed gets cut rates, right? So if people have jobs, they continue to spend. That's what the economy really thrives on, right? It's the US consumer. So let's just square that up. I'm glad that the IWM rallied even in the face of that labor report. That's it here on the daily. Let's take a look at the hourly chart, obviously in an uptrend as well. You're a little bit top heavy, very similar, I would say, to the S&P and the NASDAQ. It's not as clear though, given that you got a lot more upper wicks here in the first couple of hourly bars. So even if, in terms of location, I'm saying, so you get a little bit more distribution of the volume. We'll see that in just a second. So if the market is going to pull back on smalls, I would just say that you're really watching this. Can you support over that key pullback from here, which is the previous pivot high? You could treat this as a little multi-day range. If the daily chart can offer the higher low here, looks pretty darn good to me. If the market extends in the upward direction, you have 226, 227, and then 228.55, the upper edge of the weekly expected move as those upside areas of resistance. We can quickly come in with our intraday anchored VWAPs. Notice that they support the notion that this 617 level is sort of critical. We can also check out our Fibonacci's. Let's come from the low of the balance up to the high, and then we'll also double check the gap up. So this 38.2 aligning beautifully. I like that. And let's come in from the low end of the ceasefire gap up, which was that gap has been closed on small caps. Let's certainly acknowledge that. Your Fib 38.2 and 61.8 here, sort of in no man's land. I wouldn't read into that too much. If anything, 50% retracement is sort of hanging out right there towards that 217 level we just mentioned. Let's move into our Rusty Russell and see if there's any red flags at the exchange level. Would you look at that? There are no red flags. A little bit of a weaker close on the Monday session in terms of the advanced decline line, but you still have the same indications out of the cumulative build on the tick, as well as your volume flows technically closing positive every single day of the week. Let's jump on over to the Russell side of the market profile. You could see much more of a poor high on that Thursday session. The value area is still towards the upper third of the range, so all the same commentary as to what we've described in the ES and the NQ already. If you do get that deeper pullback, your level in the RTY futures is much closer to about 2210. 2210 as a key level. All right. So rallies, rejections underneath the value area low. I'll give you that number as well here. Around 2258, we'll call it for round number's sake. 2258, rally rejections there. Probably retarget this. Then look for stronger buyers to step up if a daily higher low is going to develop. Let's take a look at our sectors. This is where we can speed things up, definitely, because it's very straightforward through the sectors. Weekly performance in terms of posture first. What do we see? Materials lead the pack, followed by energy, then staples. I don't know about you, but that smells a little bit like a risk-off rotation as the market's pushing to brand new highs. You really want the heavier weight risk-on sectors leading the pack there. It's not that they didn't outperform. You can see the S&P up about 129 basis points, semiconductors 140 basis points, technology up 158 basis points, but on a relative basis, certainly getting much more performance from some, the lightest weight sector in the market. Materials, that's a little bit of a head scratcher, should not really be fueling the market in the upward direction as firmly as it has, and therefore the odds of a pullback may be somewhat increased. Once again, not a market crash, but just a pullback from the highs to offer a daily higher low, which has been the thesis of the video in the first place. Let's check in on these structural charts and see what's going on. So materials higher here. You can see the same thing out of the XHB, which is something we've been tracking very closely. As this broke out through the top end of the range, this box right here being the range, that's bullish for the cyclical side of the economy. All set, not a major red flag. Energy, really getting back a little bit higher away from the unaffected price from the Middle East tensions, if you will. I'd be curious to see if energy is going to continue the move in the upward direction and where US oil ultimately goes, so USO on that. If we kind of hang out in here around the $75 a barrel mark, I would think that that's a little bit more comfortable. Let's go to the crude oil contract as well. Yeah, this sort of range, right? The low end of this range is kind of what we're looking for. So 66s on crude as well. Notice that this isn't spiking out of control, but the energy sector as a whole is getting a little bit of lift in the upward direction. We'll see how that plays out over time. Let's get on over to staples. Is it really, is it truly breaking the all-time highs, fueling the S&P 500? Should we really be concerned about a risk-off rotation? No, I would say it's a general rotation among the sectors, and this is really evident on that Tuesday session, right, when the Qs and the NASDAQ pulled back more aggressively. So a general rotation is still going to remain bullish for the market, but it doesn't mean, right, that the S&P is just going to continue to move higher all the time. It means that pullback as long as it's happening on a rotational market, in terms of the sectors, probably should be bought for a higher low. Let's take a look at financials. Brand new all-time high here. That looks really solid. All set. Nothing to talk about on that. Industrials, brand new all-time high. Nothing to talk about there. In terms of real estate, sideways in the range. If rates ultimately come down a little bit, which they shouldn't be based on the strength of the labor market on Thursday, but if rates do come down, we want to continue to see this move in the upward direction for two reasons. Number one, it would indicate that people have cash on the sidelines and are not pressed, so you would watch mortgage demand for that. But then number two is really the wealth effect, right? If people feel as though their homes have a lot of equity and they're building a lot of equity in their homes, they're going to feel more comfortable spending in the economy all up, and the cyclical side just continues to roll on. So that's some sort of a watch there. If we look at the XLK, brand new all-time highs here. Is it bearish? No. Is there possibility for a pullback? Yes. 253. Any of these reference points are really fine out of the, for this is good, dare I even say this is good as well. All the way down to 242 previous all-time high, the top end of this balance range here. No red flags out of the tech sector. What about semiconductors? Let's index a little bit on this, noting that you do have an inverted hammer on the Thursday session, shortened session. If you take out the low of the inverted hammer, it possibly provides some intraday, intra-week bearish opportunities for the S&P and the NASDAQ, but is it a groundbreaking, oh my goodness, we're in a downtrend? The answer is no. I would still be seeking a higher low off of 275. If we get a little bit deeper than that, something along these lines is very reasonable to retest the top end of 264.75. This balance range back here, what do we have? A big time major daily Brigade bolt. I would be looking for longs off of this level for risk reward in the upward direction as follows. Let's take a look at let's jump into discretionary here, XLY. Nice breakout to end the week over the top end of this long-standing balance. So if we can see Tesla and Amazon really remain in gear for some further upside, I see thin structure retracement on the horizon back into some of these previous highs there. So a little bit further upside there keeps the rotation bullish once again for the S&P 500 all set. Even if it does pull back, this Brigade bolt here also makes a lot of sense. I would just really be keeping an eye on 217.65. If you look at healthcare, there's really not much to talk about here. It's no longer in the top four heavyweight sectors. It's the fifth. So as it's sideways in the range, really not impressed or concerned. If we look at utilities, a D for defensive sector, has it done anything impressive here? Not really. It's not pushing the market to brand new all-time highs. It's not leading over its all-time high. Excuse me. So therefore, it's a bullish market, right? And when we're in these circumstances, the upside takes care of itself. We know this. We could probably be a little quicker through the analysis. Here's the TLT, slightly higher in terms of the trend here, pulling back to end the week. Not a surprise given the strength of the labor market. If we look at the XLC, brand new highs. It is getting a little bit of consolidation up here as Meta and the likes start to consolidate as well. So I'd be watching this. The XLC could offer a little bit. I wouldn't call it a detrimental double top, but short-term nuanced double top. If you take out the neckline there, some thin structure retracement pullback to the previous all-time high at 105.60 probably causes a little bit of turmoil in the S&P, at least some push and pull, right? Sideways consolidation instead of just straight up like we've been seeing over the last little bit. Let's jump into the ratio grids. If you're not familiar with the ratios and how to set them up on Thinkorswim, you can check out the video tutorial in the top right-hand corner. As we take a look at the top four heaviest weights, this looks great and bullish. This looks like it's trying to put on a recovery. Let's go neutral because we're still underneath a downward sloping 50 SMA. This is kind of neutral as well. We're underneath an upward sloping or even flat 50 SMA here. This looks okay, like the opportunity for a potential higher low if we could support it. We shall see, right? We have lows, higher lows, higher lows. If this supports here and bounces, that would still be a risk on signal. So I'll give this a check with a squiggly mark. So in the top four, we really don't have any major concerns. None of these are like, watch out, this is like falling off of a cliff. So what we can do is we can look at the risk off sectors, these two here, consumer staples and utilities. Any red flags? Absolutely not. This isn't a downtrend. This isn't a downtrend. That's exactly what we want to see as the market's pushing brand new all-time highs. What about our specialized ratios? Let's take a look at the A set. We're going 5 for 6. Couldn't quite do it. 5 for 6. All of these look great. This one has a little bit of concern, but as we know, this is the small cap side of the market. Breadth is actually expanding. It's just technically happening in the value sector of smalls instead of the growth sector. So we'll keep an eye on that, but it's not enough to really change the tide to say, okay, we have one data point that looks bearish, right? How many data points have we looked at that are bullish still, right? So that is what we've got on that. Gold rolling over slightly, Bitcoin pulling back underneath the trend line. I'm really curious to see how and if this continues in the upward direction. If Bitcoin can continue the breakout of this as a bull flag, not only will it help the swing position we put on Wednesday or Thursday, was it? I'm losing track of my days, but also it acting as a risk asset probably indicates risk appetite is still elevated for equities and remains bullish as an indication overall. TLT ratio to the S&P rolling over here continues to indicate strong risk appetite for equities relative to bonds. If we take a look at the dollar and interest rates, the dollar's remained really weak. Really weak here. Even on this small and subtle counter trend move in here, I was expecting a little bit more negative pressure because of the negative correlation to equities, but just nothing, right? I mean, small little upside move immediately just going sideways. I would think if the rally really starts to extend and maybe recaptures this previous area of support and uses it as support again, 97.75 in the dollar, that might be a little bit of a red flag. So we'll make note of that and we'll be watching that intraday. But for now, the dollar has not acted as any major signal yet for the broad market. So probably just watching to see if things change, if that tone changes over 97.75. Probably worth setting an alert. We'll do that on Monday. Interest rates mildly higher on the announcement of the labor report, but as we know, we've sort of been range bound for some time now. Doesn't really change the nature of where rates have been. Let's take a look at the inverted ZT for our Fed tracker highlight, if you will, or just, a little preliminary watch. Higher. Is anybody shocked about that based on Thursday's report? The answer should be no. Let's take a look at the CME Fed Watch tool. A little bit of a reload in the background, it looks like. You can see here that the odds have now increased to 95.3% odds of a pause from what was 80, even like 78% before the labor report on Thursday. And it even looks like we are now back down to only 2 rate cuts into the end of 2025. Remember that it was 3 not too long ago, 1 and 2 now, instead of the third being priced in for December. This will continue to be a top watch, but if anything, once again, I would echo what I said on the IWM, which is we do not want weakness in the labor market just so the Fed can cut rates. That's not what it's all about. Interest rate cuts will not stimulate the economy as much as, think in terms of equal opposites, right? If the Fed needs to cut rates because people are losing their jobs, the detrimental loss of jobs is far going to outweigh any, quote, stimulus the Fed provides via interest rate cuts. And really, we all know that the market only really bottoms when the Fed turns the money printer on, not when they start cutting rates, which is why, classically, if we just go over here, may as well. Let's take a look at this chart. Let's take a look at non-farm payroll and Fed funds. No. Fed funds, where's the Fed funds and the SPX? Why can't we get that? Let's just take a look at this perhaps. And then up here, we'll go SPX. And we just want to show, you get the idea. Bear with me. Bear with me as we reset. We don't want this. We want the price. Where is the price graph? Why can't I figure this out here? Oh boy. Oh man. The SPX, if you were to overlay the SPX here and not be looking at a study, let's maybe get rid of that. There's the SPX. If you take a look at where, and I'll do this. Wow, this was just botched on my part. Thanks for standing by with me. If we do this, Fed rate cuts, right? This is rate cuts. Oh, come on. Rate cuts, right? Rate cuts for the wrong reasons. This is when the labor market's already weak. Downside, right? Downside. When the Fed starts cutting rates, oh, it's too late. Boom, downside, right? So that's the classic argument that everybody makes. When the Fed cuts rates, it's technically bearish for equities because they're responding to a deteriorated labor market. And then when the Fed starts printing money, that's when the market bottoms, right? So I know that was way too long of a way to get to the same equivalent chart, but that is the quick highlight. Back to the Fed watch, back to the economic data that we get this week. Appreciate you sticking with me on that. What do we have this upcoming week? Let's look back. First of all, strong data here. Everybody was expecting a 4.3, myself included, noting that some of the weekly claims were elevated there. We came in at a 4.1. It's pretty solid. Maybe the revisions will kick this higher a little bit, but we shall see, especially after the ADP non-farm preview at negative 33 came in. You could see the true non-farm at 147, smashing the expectation of 111 there. Hourly earnings are not indicating a wage price spiral either, and the ISM services PMI is actually deflationary here. If you take a look at prices paid versus new orders, let's go, this is prices, so let's go new orders. New orders. ISM manufacturing, no services, new orders. There we have it. So if you look at these two lines, this moving lower while this is moving higher. New orders are moving up. Prices paid are going down. That is disinflation. right? Versus when you have this moving higher and this moving lower, that is inflationary. So this is also aligning with the sort of goal of the Fed that, okay, let's sort of keep things the way they are. Let's get that inflation target all the way to 2%. And seemingly the labor market is doing all right. Now let's look forward a little bit because my goodness, that chart really threw me off with the SPX, but we're working through it. What do we see this upcoming week? Not much in terms of economic data. FOMC meeting minutes shouldn't really be market moving. It's a rehashing of what we've got, especially through the testimony of Powell in front of Congress. Jobless claims on Thursday is probably the biggest market mover, as well as some Fed speak there. Maybe the 10-year bond auction as well on Wednesday at the 101 timeframe. It's really the following week when we get CPI that the market should have, I don't want to say a temper tantrum, but probably the biggest reaction to economic data that we are looking forward to. Let's jump over here and let's take a look perhaps for earnings at the calendar. Anything worth watching out for? The answer is a big fat no. Let's get back on over to the platform then, and let's continue along with our analysis. Bonds relative to themselves indicating the same thing that we've been seeing recently. A little bit less of a concern about inflation here as the Fed is still likely to cut rates, but this uptick here indicating the 3 to now 2 rate cuts. This is all aligning, making sense, no red flags. If we look at credit spreads, both of them falling over. That, of course, is bullish for equities. If we take a look at the junk bonds, moving higher here on Friday, finally starting to confirm the move that we saw in the SPX, right? You can see the move higher here. It was offering a little bit of a divergence, right? If you recall, these lower highs in here as the market was grinding higher, but it is catching a little bit of a bid now, which is bullish. Let's move into our breadth charts. And if we take a look at the dailies, and what we can see here is the market did extend breadth in the upward direction, reinforcing the new higher highs, the all-time highs that we saw on that Thursday session. Once again, I think longs have poor trade location. That's the premise of the market profile chart. But for now, breadth expansion is technically still bullish. You could see it here in the RSP, continuing higher. You could also see it in the equal weight NASDAQ, moving higher here, not really indicating a lower high there, instead of higher high. And we can even take a look at the Dow. We haven't looked at the Dow in a very long time, and don't get me wrong, there's still a big divergence from this perspective here. However, this break, if you take this and if you take this at least is in alignment with the transports, finally starting to indicate, hey, not all hope is lost, right? So that is the main takeaway on that one. Let's move into volatility here. No big surprises. Lower on VIX, lower on VVIX, of course. No big changes over here. What about the volatility futures? Any red flags? The answer is no. Strong contangos across all durations. Same thing with the 9 versus 30-day VIX and even the 1-day VIX, although it did move higher on the expectation of the labor report on Wednesday, headed into Thursday. Thursday session was just an inside bar. You did not see an extension above the high of the Wednesday. So to me, really self-contained there on volatility, which means money managers are still doing A-OK in terms of allocation and want to be out. They're probably playing catch-up, if I'm being honest, to the market here. A lot of underexposed portfolio managers on this break in the upward direction. Let's check in on the technical charts for the core list of companies. Hopefully you're enjoying your long holiday weekend. Just figured we'd do a quick check-in here before we're back to business on Monday. Strong breakout on NVIDIA from this consolidation range. The rally's been pretty extensive, and the higher low is ideal off of the previous all-time high, 153.13s. If you take a look at the hourly chart, no issues here. Look at the hourly double bottom reversal. This was just an absolute beauty of a trade over 155. We did get follow through on that Thursday move, shortened session, and you can see the pullback is still holding up over these previous highs. We'll see where we open up on Monday. If we open in this range, I'd be less interested in trading NVIDIA. If we open over 158.50, we're trying longs as close as possible off the level to trade to blue sky territories, and that would be your upside trade. I wouldn't be short NVIDIA unless we actually take out the lows of the double bottom from back here and the previous all-time high at 153.13. This risk reward probably aims to close the gap or even offer a weekly higher low retest Brigade Bolt around that 145. That is your NVIDIA chart, and again, your weekly would probably look something along these lines, right? Then we set the higher low, and that's how you move off of 145, the top end of the previous range. Not interested in this box. Longs above, right? If we open above and stay above, longs above, not interested in the box. If we get under the box, shorts to close the gap, and then reevaluating for longs here, 145. That's the game plan. Let's move along to Microsoft. It's just a slow and steady grind in the upward direction. There's nothing bearish to say about the chart. The grind is getting a little bit balancy up here, however, on the Thursday session. If you take a look at the hourly, you've got a very similar story to the broad market as a whole. You have high and tight consolidation, which potentially is going to be offsides on the Monday open if we open underneath 498. So what you would watch for here is any rally rejections of 498 on any opens below probably yield a full rotation to the bottom end of the range at 493. be my guest. If you want to try to short Microsoft like this, I would just understand that I don't want to be fishing for longs arbitrarily in the midpoint if this is still an opportunity. Really, the only way, and Microsoft's been a really rough trader recently, the only way I would trade this is if, okay, we dip a toe in, find an arbitrary high or low, consolidate here, maybe Brigade bolts to blue sky territories up and over $500.79. On the daily chart, do you really want to bet against this freight train? It's been a straight shot higher. Let's take a look at Apple. Apple's pretty interesting here just because the daily balance range has now seen a little bit of a wall-to-wall move from the bottom end. So instead of this chop and slop and ugliness in here, did get a little bit of volatility this week in the upward direction on the main announcement of their botched AI implementation. I'm not going to go down the rabbit hole again. But if we can break out of this daily balance range, I'm pretty interested in Apple closing the gap overhead, even if it just comes up to tag the daily 200 SMA. The best watch here is really two different ideas. Number one would be that because we've seen a wall-to-wall move, let's zoom in a little bit further on this. Because we've seen the wall-to-wall move, let's just call it A to B, the market pulls back, right? This upper wick's telling us that buyers, they're pretty exhausted. We've gone from A to B, really stemming from this volatile catalyst on the extension of the upside. If we need a break, then this is the ideal spot for the next high or low. You could either try to buy the high or low. That wouldn't really be my first thought. Maybe you could make the argument it's a double bottom neckline. I would prefer not to execute in the range, but if you can retest the equal high in short proximity of time after a high or low, then the odds should increase, right, on something that looks like this for the gap close overhead. It's considered the right side of the V. So over 213 would then close the gap to 220.75. The next opportunity would be that on Monday, we extend the move in the upward direction. The market then offers a pullback to support over the top end of the balance range. Then we look for longs off of this. Let's just say it's a daily hammer. Risk, reward back in the upward direction to close the gap all the way with respect to the top end of whatever this high is in here. Those are two ways, two ideas to get involved in this Apple move. And that's really all I'm seeing. On the hourly chart, there's really not much nuance to dive into. The one thing you could maybe say is just that the market is being respectful. Notice this Brigade bolt intraday over the previous pivot high. So if Apple's going to start being respectful of the technicals, if we do have enough of a catalyst, enough new eyeballs on this, maybe the gap close overhead is interesting, but I don't want to over-index our time on that chart because, as we know, it has a pretty horrific recent history of being disappointing. So with that, let's move along to Amazon. Amazon looks great breaking out of this balance range on the daily. Brigade bolt already in force here. The next one is up and over 224 to navigate to the bottom end of this little range from back here at 228.75. If you take a look at the hourly time scale, notice that the Thursday session is completely inside of that first hourly candle. If the market consolidates in this range, the setup is in play because we have hourly higher lows. The trend, of course, remains in the upward direction. We're looking for a break in Brigade bolt over the equal highs. Consolidation. Brigade bolt here unlocks that upside trade. Once again, your target, 228.75. If you fall underneath 221.75, I'm not interested in Amazon there, and I would only be interested in shorts if you're underneath this as new overhead supply with a lower high here and probably a broad market that looks weak underneath 217.75. The question would just become, why are the buyers failing to extend the gain outside of this range break? Why are they allowing this to sort of take place? If you zoom in on this, you could maybe build the argument, right? Here's a double top, here's a neckline. It's also previous structure under the 217.75, maybe rotates to the bottom end of the range. That's probably in my view, if the broad market remains bullish, probably way too aggressive of a bear side thesis on Nancy. Let's move along to Google. I hate Google. We've hated the Google chart for a long time. This balance range is, you could call it balance, you could call it chop and slop. It's certainly trying to develop an uptrend here. It's just very, very ugly. Very, very ugly. So I'm not even inclined to say much more than, like, if you want levels on Google, there you go. These are the few levels that I have, but I don't have any big thoughts as to what to do about this chart. Really ugly price action recently. If we look at Meta, it's the exact opposite. Really clean price action, really. Recently, I should say. Here's a break, here's a break, here's a break, here's a break. Looks solid, so the next thing to ideally be looking for is if we could take out the three equal lows here at 714.50, 705.50 is calling our name for the daily Brigade bolt up next, right? If this is a balance range, Brigade bolt happening here, your ideal high or low, 705.50. We'll watch that very closely. If you take a look at the hourly chart, what I like about the hourly, which gives me some hope that we might get to 705.50, is simply the idea that on the Thursday session, the market did gap up over all of this bearish consolidation. Sellers were able to keep prices down and depressed instead of the buyers dealing with a gap and go, oh my goodness, we rallied, right? So Meta being down as the broad market was up gives me the hope that perhaps if we can see the full pullback at 705.50, we should reevaluate here and say, okay, are those buyers going to step up over the top end of the balance range? It is a picture perfect looking chart. Sometimes when it's so perfect that it doesn't work out. We saw this on Tesla, but it will at least be a priority to watch intraday. Do we see the response, right? We're not just layering limit orders down here saying blindly, I'm going to buy 705.50. But if we see the response, if we see lower wicks, if we start to see indications from the broad market that we're bullish there, if the exchange is bullish, if there's maybe a catalyst on Meta, doesn't matter what it might be. If we could support over 705.50, very interesting spot on this chart. Let's take a look at Tesla. Speaking of one of the charts that did not work out in terms of the top end of this, right? That's really what we're referencing. Remember this breakdown back a couple weeks ago. Let's just pause for a second though and say, okay, what's the daily chart actually doing? Did it make a lower low? I would say no. The daily chart is in range compression right now with lower highs and then higher lows. If this had made an equal low down to 270, 275, I'd be far more concerned. If we actually sat on this gap down going sideways, trying to break below, I'd say, okay, we're sort of losing the key moving averages. This is now all overhead supply. It looks pretty ugly. But into the end of the week, there was a decent buy-side reaction back into this range overhead. So one of the ideas for Tesla is if we're in range compression, it's not going to be the most pretty trade. However, any consolidation here that breaks over the high could easily rotate to here, 334, the top end of this balance range, and then reject. Why would it reject there? Well, right, if this is a lower high, this is a possibility for a lower high. So you continue to just sort of take advantage of those nuances of we're not really trending. Let's not overstay our welcome on the long side. We could trade this as a scalp, and we do have to battle through all of this ugliness. This is not, I would not classify this as an A+ setup. Like if we're looking for good setups and we have far better or more attractive setups on Meta, if we have better setups on Amazon, if we have something on NVIDIA, I would much prefer to trade those charts versus Tesla in the midpoint of this range. But if there's nothing going on, if we need some sort of move over the daily moving averages over that Thursday high, I could envision some kind of range rotation to 334. Right, so that's just my take here. I think the better opportunity would be if we could just re-clear this in the upward direction and get out of the chop and slop. So be my guest if you want to get chopped up in here. I'm really deprioritizing Tesla in that range unless it's a no-brainer, maybe even catalyst-driven setup. Let's continue along. JP Morgan with the banks. We saw it in the XLF. Breaking the brand new highs. It's bullish there. If you want a pullback level or a couple of pullback levels, I would say 292.30, the top end of this 3-day range, would be ideal. Something along those lines. If we go deeper than that, probably a quick scalp A to B short, and then 280.25 trying to pick it up for longs back to the high. If we look at Netflix, swing traders, it might be your time to shine again. Previous resistance acting as support, we're above it. Inside hammer on that Thursday session. Let's take a look. Inverted head and shoulders over the neckline at 1299, call it 1300, probably looking at a thin structure retracement back to about 1340, so 40 points of available upside there. Just be cautious on those options, right? Shares are probably the lucrative way to do this. That way you don't get caught up in a wide spread on the options chain. Palantir, really been deprioritizing this one over the last couple of sessions as well. Lack of clean price action inside of this range, near the all-time highs, over this, right? This overshoot, back above, overshoot again, underneath, back above. Really not looking at anything clean on Palantir right now, so just waiting patiently for some new candle structure to develop, then we'll take it in stride. You could take a look at the levels if you'd like. I would maybe just say like blanket statement, we'd be a little bit more bullish if we're over 133.50, a little bit more bearish if we're under 133.50. Let's move along to Broadcom, AVGO. Really clean V-shaped recovery happening here. Great intraday pullback on the Thursday session as well. Great shout out to anybody in the group who caught that one. And I would just say this is the name of the game, Brigade Bolt consolidation. Anything over sort of 271.35 and then Brigade bolting at 275.85 is blue sky territories. If it is going to develop a larger daily range in here, that's fine. The only time to think short would be underneath previous all-time high at 264.25, something along these lines. Maybe plays for the gap close, but given the Thursday close here, I would not be thinking that is like, okay, let's just short it here near the highs. We'd really need to see some overhead supply develop here before getting involved for the gap close there. Let's take a look at AMD on the semiconductor front as well, and then we'll get into those 6 trade ideas. 3-day balance range is really interesting on the hourly chart, right? Because if this is a double bottom, Technically, the consolidation lows on Thursday is staying over the neckline. Consolidation that persists in Brigade bolts over 139.25 looks for 142.35. Risk reward looks like a pretty decent opportunity through some thin structure on the chart off to the left. I'd be a little less interested in AMD if it just dribbles and fizzles out down here. I'd be waiting patiently for the next long opportunity either at the top end of these two highs here, or more importantly and impressively in this zone down around 125, right? That's the daily 200 SMA as well. Let's get into these ideas. Let's go to daily charts to take a look at them. My goodness. Coinbase up first. Daily bull flag, certainly in play like that, obviously with the tokenization and everything that's happening on that front. Pretty bullish for coin as a catalyst all up. If you look at the hourly chart, this head and shoulders was something that we got a little bit of a short action on it in here, but now look at it. It's almost the dual, right? So instead of head and shoulders, it's now inverted head and shoulders. And if we can actually crack up and over this 361.15s, I think that we're going at least back to this equal high around 380 would be the potential target up there. So that is Coinbase looking for about 380 on a move over 363. So many points to collect in there if it wants to go for it. The next one is certainly crypto related as well. And we saw the Bitcoin breakout also, so not a shock. MSTR is going to find its way into our watch list this week as well. Not as thrilled about this because it's not directly benefiting from all the tokenization stuff, the Genius Act that was passed. I do see this inverted hammer and I think to myself, okay, not the greatest daily structure, so it's not so clear here, but if you take a look at the hourly chart, what I would really be watching for is if MicroStrategy, we're now on MicroStrategy, if we can pull back and reaffirm that 395 is going to act supportive, that maybe starts to get us a little bit interested into the highs of the previous range from back here. So it's really a two-step process out of MicroStrategy. Can we firstly confirm again 395 as support? Because notice on the first Brigade bolt attempt, the open right here fell right through. So if this can Brigade bolt and hold it this time, that's okay. We're getting a little bit more confident. And then we probably start seeking some longs up to the top of the range or over the top end of this range at 422.25s, right, to get going in the upward direction as follows. So that's coin and MicroStrategy. Let's move along to Oracle. Oracle is up next on the lineup here, and this is a classic watch. It's been a watch for a while, actually. It just sort of always seems to slip away intraday. But look at this great Brigade bolt after the gap up open here, the extension to new highs. You can see the alerts. It's 226.50. If we look at the hourly chart, really, really clean structure. Buyers stepping up here, moving over the neckline of, you could call this maybe a little bit of a double bottom. You're just looking for a rinse and repeat, right? So 226.50s. If we can get support over that, buyers stepping up, looks good. Target the equal high and then blue skies beyond that. Next up, in the world of semiconductors, let's go to TSM. Rinse and repeat, same idea. We're still on the hourly chart. I'm sure you could envision the daily, but something that looks like this, rock and roll over these previous equal highs, 1, 2, and 3 equal highs at 228.50. If we could support above that, looks really solid here for a Brigade bolt re-entry long out of TSM. Let's take a look at Circle. Circle's lost a little bit of the hype, a little bit of the momentum, but this is probably one of the times to strike. Notice that after some of this short action came in here, and keep in mind, these are massive ranges, and the options market is not a controlled way to get involved in Circle. I would just trade shares on this outright, just a handful of shares. Not even on the short side. Short is hard to borrow, at least on Thinkorswim. If you have locates over on your other broker, Interactive Brokers, Lightspeed, whatever, then by all means you could try to short the shares. But I would stay far away from the options. Way too spready, way too thin in terms of liquidity. If you crack these highs, I think that Circle could possibly retrace through the red bar up to these highs around the 229. So, we're talking about 192.50 to 230, let's just call it, for round number's sake, right? Really, really solid opportunity there. Let's just call it $40 of potential upside, even if you only capture a fraction of that. $20 a share on something at this price point, the volatility is incredible. So over that level, I think you start to see headlines about it again. I think that you start to see the retail hype jump in here again. Notice that in the grand scheme of things, this is just a big breakout off of the open, or a big rally, you could say, as there's nothing to break out of. Pulling back, if this sets a higher low, let's just check in on the Fibonacci's as well. Why not? Why not? Let's go through the full Monty. So we didn't violate the 61.8. We are certainly overshooting the 38.2. That's not as ideal. But as long as this can sort of stay in this consolidation, Brigade bolt there, let's go to the hourly chart. This is really where it shines, right? You have your thin structure retracement overhead. I would really just be interested in this as a trade. Risk, reward, done. All right, that's Circle. When everybody loses interest, you want to be early here. And then as everybody picks up interest, you want to sell it. You want to offload it to those people. You don't want to take the suckers long, chasing it at the highest high. take the good long, unload it to the suckers later on, right? So that's Circle. Let's move into the final trade idea, which is on Uber. All these names have really been in the sphere of influence the past couple of weeks here for the market, really the month of June. If you take a look at this, high and tight consolidation after setting this double bottom gap up over the neckline. Also great consolidation over the 89.90 mark we've been looking at on the intraday charts like the hourly. Notice your upper wicks from in here. It's the opening print of that red bar as well. So it looks to me more ripe for a possible breakout from an ascending triangle up and over 93.40. If you take a look at the weekly chart, just to add the cherry on top, what's happening on the weekly? We've been talking about this, right? There is your sort of flag on the weekly. Nice breakout going for blue sky territories as and if we can get continuation in the upward direction. That's all I've got for you in today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very brief thumbs up. It's very simple. You just click a button. If you're interested in this type of analysis every single day, we run an abbreviated version of this analysis with the private group every day at the market close. If you're interested, you can check it out. You can come trade with us live in the morning. It's all included in that live squawk that you see down below. Feel free to check it out or not. As always, we'll be up in the office, the penthouse office, that is, at 8 o'clock Eastern Time on Monday morning for another episode of the Pre-Market Prep. You can hang out with us there as well. We'll see you in the office. With that, enjoy the continuation of your long holiday weekend. And as always, I will see you in the next one.